Hi folks, inflation's on the lips of everyone at the moment, so I thought I'd do a bit of a deep dive, try and explain what's going on with the economy and how that's going to be affecting people, specifically in the property space, but also what portfolio landlords can be doing to protect themselves in terms of asset class, portfolio construction, that could be helpful in de-risking your portfolio going forward. So how have we got here? What's led to the inflation? Bottom line, huge credit expansion. There's more money available, 25% more. Government debt was 1.8 trillion, it's now 2.3. That's a 25% increase, which means there's 25% more money available. If we had a pizza, you and I, the pizza was the economy, and the economy stayed the same size as a variable. We won't get into that. And we both had 2 coins. The value of that pizza is 2 coins. If we've suddenly got 4 coins, the value of that pizza is 4 coins. The pizza hasn't changed size. It's not bigger, it's not smaller. It's just the number of coins that are using to transact that value. And that's a very rudimentary way of explaining credit expansion. The other variables are obviously through the economy shrinks and grows, so our pizza size is changing, and there's also interest rates. So huge amounts of variables there. Why are we now experiencing the inflation? It takes about 12 to 24 months for the effects of inflation to be felt. Plain and simply, landlords and tenants, you're going to agree a rent for a property 12 months, 24 months, however long. Even if you try and increase and keep pace with inflation through market rate increases, you're not really going to keep pace with market rent until the tenant vacates. You tidy up the property, get it marketable again, and have 3, 4, 5, 6 people interview. That recently, the last year, has gone up, absolutely. After COVID, there was a huge boom. Rental market was really strong. That's now softening a little, but for a period, God, you could not get your hands on good quality accommodation. So we're now experiencing the higher costs. Those people on variables, mortgage rates need to be careful, but what can the central bank do, and how is this going to be felt by portfolio landlords? Central bank rate is currently at 1.25%. We've been feeling incremental 0.25% base rate rises. They're simply not enough, I don't think, for a legitimate slowdown of inflation. Money's still far too free. Over in America, the Fed are increasing 0.75% at their most recent Money Policy Committee meeting, and previous to that 0.5%. So we're really lagging them. Again, the problem we've had isn't as severe as there. They have huge amounts of money printed. Some 40+% of dollars have been printed since the COVID crisis. So that's massive credit expansion. Discounted product rates remain available on 2 to 4%, but those on variable rates do need to be looking at fixing those potentially for 2 5-year periods. That's really where the borrowers in the mortgage market will feel the pinch if these rates continue to rise up to 3, 4, 5, 6% mark. Personally, I don't think we're going to see 6% base rate. I think we might get close to 2.5, 3, but certainly not this side of December 2023. I think we've got a long way to run. So if your fixed periods are coming up in the next 6 to 12 months, it's probably not worth paying early redemption charges to get away from them. But it's a way up. It's a personal situation. If you're borrowing £1 million, 0.5% base rate rise is substantial. It might be worth paying a 1% exit fee and fixing for 5 years. It's the numbers. So look at the total cost versus the total saving of the 0.5% rise. I do think there will be a 0.5% rise between now, June 20th, and December this year, certainly. But the way the central bank have been so far, I can only see 0.25% raises. What's the biggest risk to our portfolio? As landlords, it's debt and it's servicing costs. So we have those in a very focused risk situation when we're using acquisition finance from private lenders or bridging. That same level of analysis needs to be looking at your portfolio now in an environment where we've got rising rates. So what can we do to mitigate the risk? We know that they're coming, so how can we protect ourselves? 3 critical questions that I think we should be asking ourselves. Are mortgages freely available at the price that we need them to be? Once our short-term purchase finance is concluded, and we're looking to move on to long-term mortgages. So that's buy-to-let mortgages. What's the interest stress test? This affordability has been began to become a little looser. More commercial lenders looking at Kent Reliance, your Interbays, in the HMO market and large buy-to-let space, where rising interest rates do have a much more profound impact because you're borrowing much larger sums of money. They are beginning to do a 5-year fix on the affordability rate. So if that a 5-year fix and the stress test is based on the pay rate rather than a 5.5% stress test rate. If that pay rate increases by 0.5%, where do you sit? Because as I mentioned previously, rents will lag the interest rates. So our risk is not whether rents will rise, they will rise. It's whether we can afford to service the increase in borrowing costs between where rents are today and eventually where they will get to in a rising inflationary environment. Second consideration, will mortgages be available to owner occupiers for exiting flips if we are doing capital projects or even buy-to-lets? This is really fundamental. The exit finance is critical. If it's long-term affordable interest on a mortgage product, or if it's long-term affordable mortgage for an owner occupier, unless you are flipping bungalows in Cornwall and Devon, the chances are you are very unlikely to have a cash buyer to your sale. So you need to be mortgageable, you need to be compliant with all the regulation that allows that, and the property needs to fit what mortgage lenders are looking for. Ultimately, if they're not going to lend, your exit's gone. So absolutely critical. Finally, will the rates of these mortgages be affordable? Touched on that previously with the rising interest rate and the stress test coverage. With HMOs, this isn't such an issue. It's more large buy-to-let space. So those of you that are buying, refurbing and refinancing in London, bigger consideration. The London market has been very hot to now. We do see it softening at present. Absolutely, it's softening from the highs of November, December 21, January, February 22. But that's just where we're at. Protection available to landlords. So we've got rental income protection, that's a form of insurance. Social housing leases, we'll touch on that shortly. And student housing with guarantors or other private tenants that are in more solid financial situations. Further consideration that we need to be aware of is the glut of mortgage applications in the market and the lack of processing time. Kent Reliance on our Tuition project are taking 8 business days to review any documents. That's the best part of 2 weeks. So start your applications early, be in a position to be chasing these things and really get organised, because our finance costs, our acquisition costs can be high. Being on finance for 6 months or 12 months, the cost differential in the middle there is substantial. Obviously in the bridging company, I'm always encouraging people to get the property into a lettable condition as soon as possible, and then at least you've got money coming in to help service those finance costs as you go. Thoughts on portfolio construction. Mark has given us a pretty conservative stress test. What happens if 75% of your tenants stop paying and rates are at 6%? Where do we sit? How does the portfolio look? Can we cover our holding costs? Something that certainly needs a good look at, because hey, there are going to, with the increase in utility bills and living costs, there's going to be a stretch, and the tenants that aren't doing brilliantly and that aren't at the bottom, it's that middle that are going to be squeezed, and they're going to be the ones that really struggle. So portfolio construction, looking at social housing as an income. I've really wrestled with this topic. How can we make sure that our portfolio is well hedged? It's in a position to make the most money possible from private rented sector, but also there's long-term tenants. We're not too isolated on maybe one big social housing association contract, so we do need that risk spread across a number of buy-to-lets. But what sort of percentages would we be looking at? for us looking at the buy-to-let portfolio, I was thinking around 35%, in more than your finance costs across the whole portfolio coming in from social housing is a great place to be. You've still got the majority, probably 40, 50% plus coming in from your private rented sector. That's brilliant, that's fantastic. But also having this social housing income for 30 to 35% is fantastic also. Other diversified income that you can find within the real estate space, you've got commercial tenants. What sort of businesses are going to be recession proof? Are you looking at big blue chip type tenants? Could you have more independent, smaller tenants? Play with it, have a look up and down the high street and see those tenants that have been there, anchor tenants, we'll call them, that are going to be able to afford paying that rent even in a recession. Angeling, lending funds to other investors, that's a great income stream, or another source through business. Hey, would love to hear some ideas there, so please get in touch in the comments below. Personal forecast, another topical piece of news that's come about, the rent reform bill. This is going to make things again harder for tenants to be evicted from properties. It just seems to be the way that the population's going at the moment. You've got a poorly poor society where a lot of people are in doctors' surgeries, and the employment laws are there to protect them, so they're staying in a job. And equally, that same sentiment is going to be pushed across to the housing market. An interesting stat, 45% of landlords in the private rented sector have between 2 and 4 properties. I was really surprised at that. These are really mum and pop shops, to coin an American phrase, mum and dads that have got a couple of buy-to-lets that aren't massively professional. They're not bringing in huge amounts of money. Bottom line, property's deteriorating asset class before the regulation gets involved. So retrofitting a 1910 Victorian terrace in Burnley that earns £600 a month, how the hell are you going to afford insulation on that property, solar panels on that property, upgrading the window glazing, all that sort of thing? So that's our job, buying well and being able to afford to refit these properties to a high standard that is above and beyond where the regulation is at present. Just throwing some numbers around here. So we've got, forecast there, mum and pop buy-to-let landlords will be exiting the market as this regulation and increased scrutiny continues. It's only going one way. It's going to be big portfolio landlords that can afford the maintenance, that have economies of scale, that are going to benefit from this. That's an opportunity for scaled and sophisticated buyers like us. So that's fantastic. Tailwinds working against landlords. I mentioned regulation. Green finance, we're beginning to see discounted mortgages coming in for properties EPC A, B or C. It's a 0.1 or 0.2% a year saving. Now, we're not at the point yet where brown assets, quote unquote, are receiving penalty rates, but it certainly could be. How long before the green finance is the norm and brown finance is a 0.1 or 0.2% annual penalty rate on your mortgage. Just coming back to Burnley, nothing against Burnley, by the way, lovely place. If you've got a 2-bed terrace house in Burnley through a 0.2% annual saving, I don't think all lenders go to 0.2, I think the majority are 0.1. An annual saving on a 75k mortgage at 0.2%, the upper bound, you're saving 150 quid a year. So how many years do the mum and pop buy-to-let landlord need to save up that £150 to do something like retrofit cavity wall insulation, upgrade their window glazing, for example? It's simply not profitable enough. So this is going to lead to an inability to upgrade deteriorating properties. It's going to lead them to become vacant because they're not going to be at the EPC standard that will legally allow them to grant tenants. And so that's going to cause huge issues. Mentioned previously the increase in tenant rights. So what's this going to lead to? It's extended periods for landlords evicting bad tenants, non-payers. That means that those that have come into financial difficulty through a tenant not being able to pay their rent, you're going to have longer holding costs because these people are going to legitimately be able to stay in your property for a longer period before you can get to court, before you can get a bailiff. And that's going to mean that you need to continue to pay that mortgage, or the bank are going to repossess with a bad paying tenant in situ. What does this mean, and what can be done to protect our portfolios here? With those increasing holding costs, it's all a matter of scale, really. What scale would be required for your portfolio to absorb those longer term renovation costs through the asset class deteriorating, or an increase in regulation again from maybe C to B or B to A? What level of income does the portfolio need to be able to upgrade things like solar panels that are at the forefront of technology at the moment for environmental sustainability? What proportion of social housing do you think would make your portfolio recession proof? I've gone with a relatively conservative full finance costs or more from social housing, and then private sector on top. Finally, when renovating properties, is it worth spending a little bit more, pulling things apart during refurb that much more to make sure that you're future-proofing to a higher standard so that you're ahead of regulation, not just keeping pace with it? Really interested in continuing the conversation because this is a massive growth sector for all landlords. So if you've got any ideas on how you're making your homes more sustainable, more environmentally friendly, or how you're making your portfolio more recession-proof, I'd love to hear from you in the comments. Thanks for tuning in, and be in touch.